Imagine uh, you're the pilot of this massive commercial airliner, right?
Okay.
You are cruising at a very comfortable 30,000 feet. The skies are clear, the passengers are asleep, the autopilot is just humming along perfectly.
Sounds relaxing.
Right, it's a good flight. You glance down at your instrument panel, and everything looks completely normal. But then, you blink, and suddenly your altimeter drops from 30,000 feet to 15,000 feet.
Oh, wow. Just instantly.
Just like that, in a split second. And the crazy thing is, the warning lights aren't flashing. There are no alarms blaring in the cockpit.
That is terrifying.
Yeah, and when you frantically tap the glass on the instrument panel to figure out, what just happened, there is no error code. There's just this new reality that you are suddenly halfway to the ground. And if you pull out the flight manual, it essentially just says, we changed the way we calculate altitude.
Right, which is just a deeply unsettling scenario because in that exact moment, the primary issue isn't even just the change in the altitude itself, it is the total deprivation of context. Without understanding the actual mechanics of that change, like, is the plane actually falling out of the sky or did the sensor just, recalibrate its baseline? You can't make a rational or safe decision. You are effectively flying blind while staring at a dashboard that looks completely functional.
And that right there is the perfect entry point for today's deep dive on the Gap Advisor's Ind AS Clinic.
Yeah.
We're really wading into the diagnostic landscape of corporate financial reporting today.
We definitely are.
Because sometimes the most earth-shattering changes are hidden not by being deleted, but simply by lacking a tiny, seemingly insignificant signpost.
Yeah, hiding in plain sight, basically.
Right. And whether you are an auditor prepping for a massive file review, or maybe a finance controller maintaining compliance, or just an everyday investor, trying to evaluate your portfolio, or even a CA student deep in your studies, you really need to lean into this one.
Because it affects everyone in that chain.
Exactly. The accounting standards are literally the fundamental language of the markets. It's the language of your wealth. And if you are investing your hard-earned money in shares of a listed company, you absolutely need to understand this language.
Yeah.
If you don't understand how it's constructed or how it can be manipulated through simple omission, your capital and your professional reputation are at a really profound risk.
That's completely true, because financial statements, they are the definitive medium through which an entity translates its really complex economic reality into a structured format for the outside world.
Right, a digestible format.
Yeah, and when that translation is flawed, or when the structure intentionally or even accidentally obscures the underlying truth, the entire ecosystem of capital allocation just suffers.
Totally. So before we dissect today's specific case study, let's just establish the rules of the road for this deep dive.
Good idea.
Throughout our discussion today, the functional currency and the presentation currency being discussed is the Indian rupee, or INR. Any other currency that we might mention is considered a foreign currency.
Understood.
Additionally, the financial reporting period we are analyzing begins on April 1st and ends on March 31st.
Which aligns with the standard Indian financial year.
Exactly. And it's also necessary to just state a really clear disclaimer up front. The views expressed in this deep dive are the personal views of the author of the source material, and they're not binding on you, the audience.
Right. That's a very important distinction.
Yeah, you must seek the help of a qualified professional expert before taking any action, or, refraining from any action based on our discussion today. We're analyzing an intellectual framework and a regulatory standard here. We are not providing actionable financial or legal advice.
Exactly. We're looking at the theory and the application, not telling you what to buy or sell.
Right. So with those boundaries set, let's get into the hook.
Yeah.
Let's look at the source material. We have this fascinating observation that was extracted directly from the published Ind AS financial statements of an actual publicly listed company.
A real-world scenario.
A real-world scenario, yeah. We are going to examine what looks like a minor formatting omission. Literally just a missing cross-reference number on a single line item.
Which sounds so trivial, right?
It sounds incredibly trivial, but we are going to unpack how that blank space potentially obscures a massive multi-billion rupee adjustment. And we'll explore the psychological, regulatory, and audit implications of that specific omission.
And I think what people will find is that the transition from a microscopic formatting detail to a huge macroeconomic reporting failure is surprisingly rapid. It really challenges our basic assumptions about what transparency actually looks like in the modern reporting era.
It really does. So let's start with the scene of the crime, so to speak. Let's look at the specific document in our source file. It's the Statement of Changes in Equity.
Commonly referred to as the SOCIE.
Right, the SOCIE. And we are looking specifically at the other equity section of this document. Now, for the professionals listening who deal with balance sheets and P&L statements every single day, I feel like the SOCIE sometimes gets treated as a mere reconciliation schedule.
Well, absolutely. It's often treated like an afterthought, just a roll forward of numbers to make the balance sheet balance.
Exactly.
Right.
But in this specific case, it is the primary scene of the event. So let me walk you through the exact numbers from the source image to paint a picture of this timeline.
Go ahead.
The company's retained earnings balance as of March 31st, 2018, is reported at 24,830.75 million INR.
So that's nearly 25 billion rupees in retained earnings.
Right.
And just to be clear about what that means, that figure represents the cumulative undistributed wealth generated by the company over its entire existence up to that specific point in time.
Yeah, it's their entire historical war chest.
Exactly. It's a highly critical metric for an investor assessing historical profitability or looking at the capacity for future dividend distributions or even internal reinvestment.
Okay, so you have this robust figure, almost 25 billion, yet directly below that, the very next row reads, and I'm quoting here, effective change in accounting policies.
Okay.
And the figure associated with this line is a deduction of 12,517.92 million INR.
Wow.
Yeah, it is in brackets. It wipes out more than half of the accumulated wealth. Just like that. Consequently, the restated balance on April 1st, 2018, which is literally the very next day, is just 12,312.83 million INR.
So let's really analyze the mechanics of that transition. Between the close of the reporting period on March 31st and the commencement of the new period on April 1st, over 12.5 billion rupees of recognized equity just evaporated.
It's just gone.
Yep.
And it's like checking your bank account on New Year's Eve, right? You see $24,000, you feel great. You wake up on New Year's Day, you haven't spent a dime, and your account says $12,000.
Right, and it wasn't consumed by some sort of operational catastrophe or a massive legal fine or a sudden collapse in market demand.
Right.
It was consumed purely by a change in the methodology of measurement. The bank essentially said, hey, we just changed the policy on how we count your money.
Which is wild.
Yeah.
And I want to contextualize the sheer scale of this adjustment. Because if you read further down in the exact same financial statement, the company later reports a phenomenal profit for that year of 267,646.00 million INR.
That's a massive current year profit.
Huge. And they also report other comprehensive income items, right, like remeasurements of defined benefit plans at negative 2,946.24 million and other OCI at negative 15,041.37 million. So when a company is generating over 267 billion rupees in annual profit, someone playing devil's advocate might argue, hey, a 12.5 billion rupee adjustment to opening equity, that's merely a rounding error compared to the current year profit.
Yeah, I've heard that argument, but that is a very dangerous application of the concept of materiality.
How so?
Well, materiality is not solely quantitative, right? It is
Yeah.
deeply qualitative.
Yeah.
So yes, relative to a 267 billion rupee profit in the current year, 12.5 billion might seem less significant if you just look at those two numbers side by side.
Sure.
However, looking at it historically, that 12.5 billion represented 50% of the entire accumulated retained earnings of the company up to that point, half of it.
Right. Half of everything they had ever saved up.
Exactly. If you are an investor and you're attempting to map the historical performance of this company to project future stability, discovering that half of their historical wealth didn't actually exist under this new accounting paradigm, that is a massive material revelation.
Yeah, it completely changes the historical narrative.
It does. It demands rigorous scrutiny. It's not a rounding error.
Okay, so let's dive into the actual mechanics of that revelation, because the line item literally just says effective change in accounting policies. Let's demystify what that actually means in the real world. Under Ind AS 8, when a company changes an accounting policy, say they shift the method of their inventory valuation, or they adopt a brand new standard for revenue recognition, how does that actually translate into a massive deduction against opening retained earnings? Like, why doesn't it just hit the current year's profit and loss statement?
That is a great question, and it really touches on one of the most vital principles of financial reporting, which is comparability.
Okay.
So Ind AS 8 generally requires what we call retrospective application when a voluntary change in accounting policy occurs, or when a new standard is implemented and it doesn't have specific transitional provisions.
Retrospective, so going backwards.
Right. Retrospective application means you have to adjust the opening balance of each affected component of equity for the earliest prior period presented. And you must restate all the other comparative amounts disclosed for each prior period as if the new accounting policy had always been applied.
Wow. So you are essentially rewriting the financial history books of the company.
Precisely. You are rewriting history. Because if a company decides today that a different accounting policy provides more reliable and relevant information, the standard basically argues that you cannot simply start applying it today and leave the past untouched.
Because then the years wouldn't match up.
Exactly. If you did that, comparing this year's performance to last year's performance would be completely meaningless. You'd be measuring them with two completely different rulers.
Right.
So to achieve that true comparability, you have to apply the new ruler to all the historical data.
Okay, let's trace the math on that just to make sure I have it. Let's say a company has been recognizing revenue really aggressively for 5 years. Then suddenly, they adopt a new policy that defers that revenue over a longer period. They would have to calculate the difference between the aggressive method and the deferred method for year 1, year 2, year 3, year 4, and year 5, right?
Yeah. Correct. You calculate the difference for every single one of those years. The cumulative effect of that policy change on all years prior to the earliest comparative period presented in the current statements is aggregated. You smash it all together.
Yeah.
And that massive aggregated sum is then posted directly against the opening balance of retained earnings. It entirely bypasses the current year's statement of profit and loss.
And I'm guessing the logic for bypassing the P&L is to protect the integrity of the current year's operational metrics.
Yes, exactly.
Because if they dumped a 5-year cumulative adjustment of 12.5 billion rupees into the current year's expenses, it would look like the company had a catastrophic operational year, when in reality, they just changed the math formula.
You nailed it. The matching principle dictates that current year performance should reflect current year operations. Putting prior period cumulative adjustments into the current P&L would severely distort the user's understanding of what the business actually did this year.
It would look like a disaster.
Right. Therefore, the standard meticulously quarantines these historical adjustments over in the statement of changes in equity.
Which really highlights why the associé is so critical. Because if an analyst or an auditor only looks at the P&L, they just see a massive 267 billion rupee profit.
They'd be thrilled.
They'd be thrilled. And they would completely miss the fact that the foundation upon which that profit was built just shifted downwards by 12.5 billion rupees overnight.
Right. The associé forces you to look at the actual residual wealth of the owners. And when that wealth contracts by 50% overnight due to a policy change, the immediate, urgent requirement for any user is an explanation. In AS8 actually mandates really extensive disclosures for this exact scenario. The entity has to disclose the nature of the change, the specific reasons why applying the new policy provides reliable and more relevant information, and the exact amount of the adjustment relating to all those prior periods.
Wait, and this brings us to the central conflict of our source material today.
Yeah.
Because if I am looking at a 12.5 billion rupee adjustment, I naturally want to read those exact Ind AS 8 disclosures you just mentioned.
Of course you do.
I look at the line item on the associé, expecting some sort of roadmap. But in the published financial statement that GAAP advisors reviewed, there is no cross-reference. The space next to effective change in accounting policies is completely blank. There's no superscript note 45 or note 2.1 to guide me anywhere.
Exactly. So the company calculated the retrospective impact, they did the hard math, they adjusted the opening equity, and they printed the line item right there on the face of the associé.
Right.
But they completely failed to provide the navigational link to the explanatory notes.
Yeah, let me push back a little bit here. Let me play devil's advocate. We operate in a highly digitized environment today.
True.
If I am reviewing a 300-page annual report, usually I'm doing it in the PDF format. If I see this unreferenced line item, I can simply press CTRL-F, type change in accounting policy, and let the search function find the note for me.
Sure.
So why is a missing numerical cross-reference, considered such a massive red flag for compliance when we have modern search tools that can just find the text?
Well, it's a common defense, but it fundamentally misunderstands the architecture of a financial statement and, more importantly, the cognitive burden placed on the
The
user.
cognitive burden.
Yeah. A financial statement is a statutory document. It's governed by strict presentation frameworks. It's not just a casual PDF newsletter. When you rely on a text search for something like change in accounting policy, you are likely going to generate dozens, if not hundreds, of hits throughout a 300-page document.
I mean, I guess that phrase is probably everywhere.
It is everywhere. It will appear in the auditor's report. It'll be in the director's report, the significant accounting policies summary, various risk disclosures.
That makes sense. A keyword search gives me raw data, but it doesn't give me the specific structured context of that exact 12.5 billion rupee figure.
Exactly. The user is essentially forced to sift through mountains of textual noise just to find the specific quantitative breakdown that is mandated by Ind AS 8. The standards are actually designed to minimize the cognitive load on the user.
Right. They want to make it easy.
Right. The cross-reference is the architectural bridge. It explicitly links the aggregated macro-level impact on the face statement with the disaggregated micro-level explanation back in the notes. When you sever that bridge, you violate the core principles of presentation.
So let's examine the specific regulatory mandates that actually enforce this bridge, because it's not just a suggestion, right? We have two distinct layers of authority here. First, there's the corporate law. Let's look at Division 3 of Schedule 3 to the Companies Act, 2013, specifically Clause 4 of the General Instructions for Preparation of Financial Statements.
A very specific reference, yeah.
Our source material quotes it directly. It says, and I'm quoting, "Each item on the face of the balance sheet, statement of changes in equity, and statement of profit and loss shall be cross-referenced to any related information in the notes."
Right, and notice the imperative nature of the word shall.
Shall, not should.
Exactly. It is not a suggestion. It is not a best practice guideline that you can opt out of. It is a strict statutory mandate. The preparer of the financial statements has a legal obligation to provide that cross-reference.
But the clause continues with this really fascinating philosophical directive, which I found so interesting. It states, "In preparing the financial statements, including the notes, a balance shall be maintained between providing excessive detail that may not assist users of financial statements and not providing important information as a result of too much aggregation."
Yeah, that sentence really articulates the perpetual tension in financial reporting. It's always a balancing act. On one hand, you have the risk of excessive detail. If an entity attempted to put all of the Ind AS 8 disclosure requirements directly onto the face of the society,
Oh man, it would be a mess.
it would be completely unreadable. The statement would stretch across multiple pages, defeating its entire purpose as a clear, concise summary of equity movements.
It would be like trying to read a map that is drawn at a 1-to-1 scale. The sheer amount of detail makes the map completely useless for actually navigating.
Precisely. You would suffer from complete information overload. The primary users, so, investors, analysts, creditors, they need to quickly grasp the macro trends before they dive into the micro details. So the standards require aggregation on the face statements, but as the clause warns, there is an inherent danger in too much aggregation.
Right, the danger of masking the material realities underneath.
Yes. Because when you aggregate 5 years of complex retrospective calculations into a single vague line item called effective change in accounting policies, you have achieved maximum aggregation. You've boiled it down to one number.
Right.
And the only mechanism that legitimizes that extreme aggregation, the only thing that keeps it from just becoming concealment, is the cross-reference to the detailed notes.
That makes perfect sense.
The cross-reference allows the face of the statement to remain clean and readable, while simultaneously guaranteeing that the granular detail is instantly accessible to anyone who wants it.
And this legal mandate in the Companies Act is perfectly mirrored in the accounting standards themselves, right? Paragraph 113 of Ind AS 1, Presentation of Financial Statements, reinforces this exact concept.
It does.
It states that an entity must present notes in a systematic manner, considering the effect on understandability and comparability. And it explicitly requires that an entity shall cross-reference each item in the balance sheet and in the statement of profit and loss, and in the statements of changes in equity and of cash flows to any related information in the notes.
So what you have there is the standard providing a double lock mechanism.
Right, the law and the accounting framework.
Both the corporate statute and the accounting framework demand this systematic linkage. Because a financial statement is supposed to be an integrated ecosystem. The face statements are the executive summary, the notes are the technical appendices. Without the cross-references, you don't actually have a cohesive financial statement. You just have a collection of disconnected data points floating around.
Which perfectly sets up this incredibly deep psychological and regulatory concept of obscuring information. Because if I am an auditor and I see a missing note reference, my concern isn't just about sloppy formatting. My real concern is about the impact of that omission on the user's ability to understand the economic reality of the entity. And AS1 addresses this explicitly, doesn't it?
It does, and it does so by essentially elevating the concept of clear communication to an ethical and regulatory imperative.
Wow.
Yeah. Paragraph 7 of Ind AS 1 provides the definition of material information, but it also introduces this critical concept of obscuration. It states that information is obscured if it is communicated in a way that would have a similar effect on the primary users of financial statements as omitting or misstating that information.
I really want to emphasize the gravity of that phrasing for the audience. The standard is legally equating the act of hiding information in plain sight, whether through poor formatting, scattered presentation, or dense jargon, with the act of flat-out lying about the information or deleting it entirely.
That is exactly what it's saying.
So if the user cannot readily comprehend the disclosure because of how it is presented, the fact that the company technically printed the words on page 245 is completely irrelevant. The regulatory effect is the same as an omission.
It shifts the burden of comprehension entirely onto the preparer. You cannot simply dump raw data into a document and claim you're being transparent.
Right.
You must curate and structure that data so that a reasonable user can navigate it and understand it. And paragraph 7 actually provides 5 specific practical examples of circumstances that result in obscured information. Analyzing these circumstances provides a masterclass in the cognitive vulnerabilities of financial review.
Okay, let's systematically break down these 5 circumstances because I think this is where the rubber meets the road. Let's start with circumstance, which states, information regarding a material item, transaction, or other event is disclosed in the financial statements, but the language used is vague or unclear.
So this targets the classic issue of corporate obfuscation. Often, when a company is dealing with a highly sensitive or really negative event like perhaps a complex contingent liability related to environmental litigation or maybe a massive failure in a major joint venture, the narrative disclosures become heavily sanitized.
The lawyers get involved.
Exactly. The preparers might use this really complex, passive voice legal phrasing that technically describes the event, but practically prevents the user from understanding the actual financial risk.
Give me an example of what that sounds like. Like, instead of stating, we lost our largest customer and we were writing down $5 billion in dedicated manufacturing equipment, what would they say?
They might write something like, management is currently evaluating the recoverable amount of certain specialized asset groups in light of evolving strategic realignments within our primary customer demographics.
Oh, wow. So it's technically true, but it is deliberately opaque. It totally obscures the reality.
Exactly. The user reads the paragraph, but the economic truth remains completely hidden behind a wall of jargon.
Okay, so that's A. Now let's look at circumstance B, which is the exact failure identified in our source material today.
Yeah.
Information regarding a material item, transaction, or other event is scattered throughout the financial statements.
Right. This is the missing cross-reference scenario. The aggregate number is sitting on the SOCI on page 15. The narrative explanation of the policy change is buried somewhere in the significant accounting policies on page 80, and the quantitative breakdown required by Ind AS 8 is sitting randomly in note 42 on page 210.
So when you scatter the components of a single economic event across a massive document without providing a systematic linkage, you force the user to pay a massive cognitive tax.
Absolutely.
Let's consider the workflow of an auditor who actually encounters this in the wild. An auditor is reviewing the SOCI and they see this 12.5 billion rupee deduction. They know they must test this adjustment, right?
Yeah, they have to. They need to verify the arithmetic of the retrospective calculation, assess whether the new policy is actually appropriate, and ensure all Ind AS 8 disclosures are present.
But without the cross-reference, the auditor's workflow is completely broken. They literally have to suspend their substantive testing of the equity balances to embark on a document-wide scavenger hunt.
Right. They are relying on text searches, crossing their fingers, and hoping the preparer used predictable terminology.
And this introduces a massive risk of material misstatement, doesn't it?
It does, because if the information is sufficiently scattered, the auditor or the investor might fail to locate all the relevant components. They might find the narrative description but completely miss the quantitative breakdown.
Yeah.
And then they might conclude their review based on incomplete information simply because the formatting prevented them from assembling the complete picture. The scattering itself becomes a barrier to audit quality and investor comprehension.
It's like reading a choose-your-own-adventure book where the author forgets to tell you which page to turn to next. The ending is technically in the book somewhere, but practically you are totally lost in the woods.
That's a perfect analogy. It's a brilliant psychological insight by the standard setters. They recognize that human attention is a finite resource.
Absolutely. Okay, let's move to circumstance C. Dissimilar items, transactions, or other events are inappropriately aggregated.
So this occurs when a company blends distinct material items into a single generic line item, thereby masking the individual significance of each component.
Okay, so squishing different things together.
Right. Imagine a scenario where a company has a massive one-time gain from the sale of a subsidiary, but simultaneously they incur a massive one-time loss due to an impairment of goodwill.
Okay.
If they aggregate these two dissimilar events into a single line item called other net gains and losses, the net number might appear relatively small and immaterial.
Right, the net number might be near zero, giving the illusion of a quiet, uneventful reporting period.
Exactly, but the reality is that the underlying economic structure of the entity has fundamentally changed. A major asset was sold, and a major investment completely failed. By inappropriately aggregating these dissimilar items, the company obscures the volatility and the massive strategic shifts occurring beneath the surface. The user is denied the opportunity to analyze the gain and the loss independently.
Which leads us to the inverse problem, circumstance.
Hmm.
Similar items, transactions, or other events are inappropriately disaggregated.
We often see this when a company wants to distract from a large, uncomfortable expense category.
Oh, interesting. Like what?
Well, instead of reporting a single comprehensive line item for employee benefit expenses, which might reveal a massive, embarrassing spike in executive compensation,
Oh, I see.
the entity disaggregates the expenses into a dozen obscure subcategories scattered across various functional line items.
It's the strategy of death by 1,000 cuts. You break a material number into so many immaterial fragments that the user cannot easily piece them back together to see the total magnitude. You basically hide the forest by forcing the user to examine every individual leaf.
That's exactly how it works. And finally, we have circumstance. The understandability of the financial statements is reduced as a result of material information being hidden by immaterial information to the extent that a primary user is unable to determine what information is material.
This is perhaps the most insidious form of obscuration. It is the literal needle in the haystack strategy.
It really is. Modern financial statements have grown exponentially in length over the past 2 decades. Much of this growth is driven by boilerplate disclosures, generic risk factors that apply to literally every company in the industry, and immaterial compliance checklists.
Just pages and pages of legal padding.
Right. So when a preparer buries a critical, highly specific, and deeply material disclosure, such as a covenant breach on a major loan facility, deep within 50 pages of generic, immaterial risk commentary, they are obscuring the truth.
Because the user suffers from disclosure fatigue.
Exactly. They stop reading carefully because they are overwhelmed by the immaterial noise, and consequently, they miss the material signal.
So, applying all of this back to our case study today, the failure to include a cross-reference for a 12.5 billion rupee adjustment clearly triggers circumstance.
Okay.
B, the information is scattered, the linkage is broken. The statement, therefore, is presented in an obscuring manner, which is a direct violation of the core mandate of Ind AS 1.
It is a structural failure that directly compromises the reliability of the document. And the fact that this occurred in the published financials of a listed company, meaning it passed through multiple layers of internal and external review, really highlights a systemic vulnerability in the profession.
Let's expand on that vulnerability and transition into discussing the global ecosystem, because these standards do not exist in a vacuum. We have been citing Ind AS, the Indian accounting standards, throughout this episode. But capital markets are borderless.
They are.
How does this specific issue, the requirement for cross-referencing, and the strict prohibition against obscuring information, translate to the international arena? Suppose an analyst is reviewing a company based in London or Frankfurt, governed by IFRS. Does this entire analysis still hold weight?
Absolutely. It holds identical weight. This is a crucial point for professionals navigating the global financial landscape. While the specific response in our source material was formulated under the Ind AS framework, there is no substantive difference between Ind AS and IFRS regarding this specific topic.
So they are essentially mirrored standards.
Correct. The Ind AS framework is largely converged with IFRS. Paragraph 113 of Ind AS 1, which mandates the cross-reference, is a direct equivalent of paragraph 113 of IFS 1 under the IFRS framework.
Oh.
Furthermore, the extensive guidance on what constitutes obscuring information found in paragraph 7 of Ind AS 1 is identical to the guidance in ISO 1. Therefore, whether you are auditing a company in Mumbai under Ind AS or analyzing a conglomerate in Toronto under IFRS, the regulatory philosophy and the strict mechanical requirements are identical.
So it's universal.
Yes. The prohibition against scattering information without a cross-reference is a universal tenet of modern financial reporting.
That universality makes this observation incredibly valuable. Now, I want to emphasize the source of this observation because I think this is vital. This was not a theoretical textbook problem contrived in a classroom to trick students.
No, not at all.
This was extracted from a real, publicly available financial statement. It was downloaded and reviewed suo moto, meaning on their own proactive motion, by GAAP advisors.
The suo moto nature of this review is fascinating to me. It demonstrates the critical necessity of independent, unburdened review.
What do you mean by unburdened?
Well, think about the life cycle of a corporate annual report. The internal finance team spends months drafting it. They are under immense pressure, dealing with late journal entries, complex valuations, and incredibly tight deadlines. They become incredibly close to the document.
Right.
They suffer from preparer's blindness. They know where the Ind AS 8 note is located, so their brain subconsciously fills in the missing cross-reference on the SOCE when they proofread it.
They don't see the omission because they already know the answer. Their brain just skips right over the blank space.
Exactly. Then the draft goes to the audit committee, who are often focused on the macro narrative and the high-level estimates rather than formatting compliance. Finally, it goes to the external statutory auditors.
And surely the auditors should catch a missing cross-reference on a 12 billion rupee line item, right?
Yeah.
I mean, that's their job.
In theory, yes. But auditors are operating under intense time budgets. They are utilizing standardized checklists. If the audit file documents that the Ind AS 8 disclosures were drafted and reviewed for accuracy, the auditor might tick the box for disclosure compliance, completely missing the fact that the crucial linkage, the physical cross-reference on the primary statement, was dropped during the final formatting and printing process.
So it falls through the cracks.
Right. It requires a fresh, independent set of eyes, entirely removed from the drafting fatigue, to spot these structural failures.
This highlights the immense value of the resources provided by GAAP advisors. I want to point you, our listeners, to the specific origin of this case study. This exact breakdown was featured in the 214th edition of the GAAP Advisors Task Weekly newsletter.
It's an excellent newsletter.
The newsletter is authored by C.A. Menish C. Iyer, Director of GAAP Advisors, and it is published regularly on LinkedIn.
The consistency of that output is just remarkable. Over 230 editions have been published to date.
That's incredible.
For a professional dealing with complex accounting standards, having access to an archive of real-world suo moto observations is an unparalleled learning tool. It shifts the learning paradigm from abstract theory to applied real-world forensics.
Absolutely. If you are an auditor, a finance controller, or a CA student, and you are active on LinkedIn, you must subscribe to the Task Weekly newsletter. It is completely free. It delivers rigorous, practical analysis of Ind AS applications directly to your feed. It trains your eye to look past the aggregate numbers and actually examine the architecture of the statements.
It acts as an ongoing practical education in professional skepticism. When you read case studies like this, you realize that compliance isn't just about getting the math right. It's about mastering the presentation framework to ensure clear communication.
So let's focus on solutions and tools. We have spent considerable time unpacking the dangers of obscured information and missing cross-references, but I want to arm the professionals listening with concrete resources to prevent these failures in their own work. Let's discuss the platform at godsadvisors.com.
Yes, the platform represents a massive repository of technical knowledge. Currently, the issue repository on the site hosts over 4,500 specific real-world issues and detailed responses concerning Ind AS and Indian GAAP.
Over 4,500 issues. That is not a generalized summary of the standards. That is a highly specific searchable database of the exact friction points where theory meets practice.
How does a professional interact with this resource?
The mechanics are designed for immediate practical support. Anyone can register on the site for free. If you are an auditor dealing with a complex classification issue or a preparer struggling with the retrospective application mechanics of Ind AS 8, you don't have to guess. You can submit your specific issue on Ind AS or Ind GAAP directly through the platform.
And then what happens?
You will receive a rigorously analyzed written response delivered directly to your registered email inbox. I want to highlight the specific value of this for the audit community. In the current regulatory environment, the burden of documentation on an auditor is immense. Regulatory oversight bodies are meticulously examining audit files. An auditor cannot simply conclude that an accounting treatment is appropriate. They must document the extensive technical rationale behind that conclusion.
And that is exactly where a written response from JAP advisors becomes an invaluable asset in the audit file.
Right.
When an auditor encounters a subjective or highly complex application of a standard, consulting with an external technical expert and retaining that written analysis demonstrates a rigorous, skeptical approach to audit evidence. It fortifies the audit documentation against subsequent regulatory scrutiny.
It provides an independent, authoritative anchor for the auditor's judgment. But it is not just for the auditors. Let's consider the preparers, the CFOs, the finance controllers, the boards of directors who ultimately sign these financial statements and take legal responsibility for their accuracy. What is their best defense against inadvertently publishing obscured information?
Their best defense is preemptive, independent review. Based on the reality of preparers' blindness that we discussed earlier, relying solely on internal review mechanisms is incredibly risky. We strongly suggest that companies get their financial statements reviewed by GAAP advisors before they are signed and published.
Catch the missing cross-references, the inappropriate aggregations, and the vague disclosures before they become a permanent part of the public record.
Exactly. Companies can submit their financial statements in a near-to-publishing PDF format via email to info@gapadvisors.com. An independent review specifically focused on Ind AS presentation and disclosure compliance acts as a critical final layer of quality control. It protects the company from reputational damage and regulatory blowback.
And finally, let's consider the ultimate end user of this entire ecosystem, the investor. The person allocating capital based on the assumption that the financial statements provide a true and fair view.
For the investor, the lesson is caveat emptor. Let the buyer beware. You cannot blindly trust the aggregate numbers on the face of the P&L or the balance sheet.
Because half of it could be an accounting adjustment.
Exactly. If an entity is demonstrating a pattern of obscured information missing note references, aggressive aggregation, dense boilerplate disclosures, it is a massive red flag. It indicates either a weak internal control environment regarding financial reporting or, more concerningly, a deliberate attempt to manage the narrative by hiding the details.
Therefore, a specialized review of a company's financial statements for strict Ind AS compliance isn't just an academic exercise. It is a fundamental tool for capital preservation. If you are considering a major position in a listed company, ensuring that the financial architecture is transparent and compliant is a prerequisite to making a sound decision on whether to buy, hold, or sell the shares.
Absolutely. The integrity of the data dictates the integrity of the valuation model. If the data is obscured, the valuation is a complete fiction.
And for those professionals who are navigating highly complex, bespoke reporting issues that require more than an email response, there's a mechanism for direct engagement. You can book a one-on-one consultation regarding your specific Ind AS and IFRS issues directly with the author, CA Manish C. Iyer, through his page on topmate.io. Having direct access to a technical expert to talk through the nuances of a complex transaction is a tremendous resource.
It allows for real-time stress testing of proposed accounting treatments against the rigorous requirements of the standards. It's incredibly valuable.
As we conclude this extensive analysis, I want to pivot our perspective towards the future. We have spent this deep dive exploring the psychological and regulatory importance of the cross-reference. We have analyzed how a missing superscript breaks the human user's ability to navigate a complex document. But the landscape of financial reporting is undergoing a massive technological shift.
Oh, absolutely. The digitization of financial data is perhaps the most significant structural change since the adoption of standardized accounting frameworks.
Exactly. We are moving rapidly toward machine-readable formats. Consider XBRL extensible business reporting language. In an XBRL filing, the concept of a visual cross-reference is fundamentally altered. Every single data point, every number on the SOCI, and every text block in the notes is tagged with metadata.
Furthermore, we are seeing the aggressive integration of artificial intelligence and large language models into financial analysis. An AI doesn't read a PDF page by page. It ingests the entire unstructured data set simultaneously.
This presents a profound philosophical question about the future of Ind AS1 and the definition of obscured information. Let's revisit paragraph 7, circumstance B, information being scattered. Into a human auditor or investor, a missing cross-reference makes the explanation for a 12.5 billion rupee adjustment effectively scattered and hidden. It induces a massive cognitive load.
But to an AI specifically trained on financial document architecture, the missing cross-reference is completely irrelevant. The algorithm instantly maps the term change in accounting policy on the SOCI to the quantitative disclosure required by Ind AS 8 in Note 45, regardless of whether a human-readable link was actually printed on the face statement.
So my provocative question to you and to our listeners to mull over on their own is this. As machines become the primary processors of financial statements, does the concept of obscured by scattering become obsolete? If an algorithm can effortlessly assemble the scattered pieces of data in milliseconds, is the company still guilty of obscuring the information?
That is a brilliant technological paradox. I mean, if the definition of obscuration is tied to the cognitive limitations of the primary user, and the primary user is now a machine with unlimited cognitive capacity for pattern recognition, then technically the information is no longer obscured. The machine understands the economic reality perfectly.
But let me challenge that premise. Does handing the navigation entirely over to the machine absolve the preparer of their responsibility to communicate clearly to humans? Or does it make human-centric formatting rules like the cross-reference even more critical?
How do you mean? What's the risk there?
Well, if we allow preparers to abandon logical human-readable structuring, if we basically say, don't worry about cross-references, don't worry about logical sequencing, just dump the tag data into the file because the AI will sort it out, we effectively lock the human out of the verification process.
Ah, I see. We create a black box.
Exactly. If an auditor, a regulator, or a board member wants to independently verify the AI's conclusions, they must be able to read the source document themselves. If the source document is a chaotic, unstructured data dump lacking cross-references and narrative coherence, human oversight becomes impossible. We become entirely reliant on the algorithm's interpretation of the fragmented data.
That is a compelling and honestly somewhat terrifying argument. It suggests that strict adherence to presentation standards, demanding cross-references, appropriate aggregation, and clear narrative linkages is no longer just about convenience. It is about preserving human agency and human accountability in the financial markets. The cross-reference is the tether that keeps the financial reporting ecosystem accessible to human comprehension.
It ensures that the language of wealth remains a human language, even in the age of machines. That is a thought worth carrying forward as you approach your next set of financial statements.
It fundamentally revalues the importance of those tiny superscripts on the balance sheet. They aren't just numbers, they are a lifeline for transparency.
I want to express my deepest gratitude to you, our listeners, for dedicating your time to this rigorous exploration today. We traversed from the mechanics of Ind AS 8 retrospective applications to the cognitive psychology of audit workflows, and finally to the philosophical future of digital reporting. Engaging with these complex, nuanced topics is the hallmark of a true professional.
The meticulous study of the standards is what separates adequate compliance from genuine financial leadership. It has been a privilege to dissect these mechanics with you.
Before we sign off, I have two important requests for you.
Right.
First, please take a moment right now to follow or subscribe to the Gap Advisors Ind AS Clinic Deep Dives. Whether you are listening on Spotify, Amazon Music, or YouTube, whichever platform you prefer hitting subscribe ensures you are notified whenever we unpack a new critical observation.
Continuous engagement is the key to mastering these evolving frameworks.
My second request is equally vital. The insights we explored today, the devastating impact of a missing cross-reference, the definition of obscured information, the resources available at gapadvisors.com, this knowledge must be disseminated. Please, share this deep dive among your professional networks. Send it to your contacts, distribute it within your audit and finance teams, and share it with your colleagues.
And most importantly, please share it with students currently pursuing their CA course. Providing them with real-world forensic analysis of the standards early in their education will fundamentally elevate their professional capability.
We have a collective responsibility to spread the profound knowledge of Indian accounting standards. Every professional who understands how to identify obscured information strengthens the integrity of the entire financial ecosystem.
Transparency is a collective effort. It takes all of us looking closely at the details.
So as you return to your audits, your financial models, or your studies, remember the altimeter in that airplane. Do not accept the aggregated numbers at face value. Demand the context. Search the cross-references. And if the linkage is missing, recognize it not as a typo, but as a critical structural failure. Thank you for investing your time with us on this deep dive. Stay curious, stay skeptical, and we will see you next time.